Alright, well that's a little better. Good evening, ladies and gentlemen. How we doing? Spectre here with another edition of Midnight Rider. Sorry for the little bit of a hiccup here, but obviously when you switch back and forth between channels and whatnot, sometimes things get flubbed up, and I thought I had everything squared away until apparently I shut down my system here and things decided it wanted to revert back to the old settings, and so things must have gotten a little jacked up there. But nonetheless, tonight on the broadcast, we're going to talk a little bit about finances, where things are headed by way of all the global debt, the Federal Reserve, gold, Bitcoin, a little bit of everything here tonight. So that's exactly where we're going to head tonight. So that being said, stick around. We'll see you back on the other side. As the saying goes, get woke, go broke. We, the people, recently learned that 200 woke corporations, part of the Civic Alliance, and 90 CEOs in a Zoom call, went on record to oppose election integrity laws in Georgia. These corporations think they know what's best for we, the people. These corporations think they wield more power than we, the people. These corporations openly flaunt and thwart the will of we, the people. These corporations hide behind like personhood, thereby giving said corporations, dead entities, rights like we, the people. These corporations virtue signal at every opportunity what values we, the people, should embody. We, the people, have forgotten how to play the game, and it's time to step into the light of the Great Awakening. We, the people, have more power than they know. We, the people, have the ability to vote with our dollars. We, the people, have had enough of the fraud and are collectively throwing up the window and yelling, "We're mad as hell, and we're not going to take it anymore." We, the people, keep our tongues from evil and our lips from speaking lies, while these corporations have given our mouth to evil and our tongues frame deceit. We, the people, will have no fellowship with the unfruitful works of these corporations. Rather, we, the people, admonish them. We, the people, having souls, know our rights are inherent and come by the hand of God, whereas these corporations are soulless and rely upon man for their privileges, masquerading as rights. We, the people, will continue to witness the destruction of the old guard. And we, the people, will build around, through, and without these corporations. So help us God. This has been a PSA by Breaking Spectre. Alright, welcome back everybody. Like I said, tonight on the broadcast we're going to talk a little bit about finance, and we got a little bit of ground to cover here. But first, before we do, I think what I will do is highlight the fact that today, if you were paying attention, a new platform tried to kick off, frankspeech.com, Mike Lindell's piece. I'm going to leave that up for the broadcast tonight, as it appears that they're going to be running for probably about the next probably 24 hours plus yet. I think it's a 48-hour, basically, lack of a better term, infomercial while people wait to try and get signed up. They had some DDoS attacks and whatnot go on here this morning, kind of wiped things out a little bit, had to rely on a backup plan. Maybe this was a plan all along, I don't know, we'll see. But I had a number of guests on here, and it was probably about half hour ago, I think Mike finally took a little break and had some other folks come in and do a little hosting. Looks like he might be coming back here as we speak, so I'm going to leave that up for the duration here, and you guys can enjoy that on the side as well. That being said, let's get into it here. Gold Switzerland had this article back here a couple days ago on the 2.3 quadrillion global time bomb. And this by Egon von Greyers over at Gold Switzerland. Says Credit Suisse is hours from collapse, and the consequences could be a systemic failure of the financial system. Well, disappointingly, my dream last night stopped there, so unfortunately I didn't experience what actually happened. As I warned in last week's article on Archegos and Credit Suisse, investment banks have created a time bomb with the 1.5 quadrillion derivatives monster. And I guess I'll pause right there. You heard me talk a little bit about the Archegos and Greensill business and that has been going on, as well as the major issue we're about to have as perhaps some of these derivatives start to unwind. Be a big game of musical chairs, and unfortunately there just won't be enough chairs for everybody to sit at the very end. Says a few years ago, the BIS, or the Bank of International Settlement in Basel, reduced the 1.5 quadrillion to 600 trillion with a pen stroke. But the real gross figure was still 1.5 quadrillion at the time. According to my sources, the real figure today is probably over 2 quadrillion. And isn't it funny that just with a pen stroke they can just make stuff disappear almost as quickly as the Fed can make money out of thin air? What are we really playing with here, folks? A major part of the outstanding derivatives are OTC, or over-the-counter, and hidden in off-balance sheet special purpose vehicles, SPVs. Leveraged assets just go up in smoke. The $30 billion in Archegos derivatives that went up in smoke over a weekend is just the tip of the iceberg. The hedge fund Archegos lost everything, and the normal uber-leveraged players, Goldman Sachs, Morgan Stanley, Credit Suisse, Nomura, etc., lost at least $30 billion. These investment banks are making casino bets that they can't afford to lose. What their boards and top management don't realize or understand is that the traders, supported by easily manipulated risk managers, are betting the banks on a daily basis. Most of these ludicrously high bets are in the derivatives market. The management doesn't understand how they work or what the risks are, and the account managers and traders can bet billions on a daily basis with no skin in the game, but massive potential upside if nothing goes wrong. And if you remember right, when I talked about Archegos, I believe they were called contracts for CFDs, contracts for delivery, I believe they're called. And basically they can leverage these puppies up to about 10 times the amount actually fronted. And by the way, in the case of Archegos, they just walked away, and of course Credit Suisse, because they were one of the later ones to the party, they didn't sell off the shares net of Viacom and whatnot like Goldman Sachs and Morgan Stanley did. Well, they were the ones holding the bag, and so the end result is we've seen quite a few firings, and of course the old day traders over at Credit Suisse probably aren't going to be getting any bonuses this year. So cry a river. The Deutsche Bank derivative 600x equity says, but we are now entering an era when things will go wrong. The leverage is just too high, and the bet's totally out of proportion to the equity. Just take the notorious Deutsche Bank that has outstanding derivatives of about 37 trillion euros against total equity of 62 billion. Huh? All right, billion to trillion, 62 billion. How many billions, 62 billions does it take to get to 37 trillion? And of course, some simple math for those not on Common Core. You'll quickly be able to find out how much leverage that actually is. Says the derivatives position is 600x the equity. There you go. Says, or to put it in a different way, the equity is 0.17% of the outstanding derivatives. So a loss of 0.2% on the derivatives will wipe the share capital of the bank and the bank out. Well, wouldn't that be a terrible thing if the banks just suddenly, poof, disappeared? Now, the Deutsche Bank risk managers will argue that the net derivatives positions is just a fraction of the 37 trillion at 20 billion euros. That is, of course, nonsense, as we saw with Archegos when a few banks let $30 billion over a weekend. It says derivatives can only be netted down on the basis that counterparties pay up, but in a real systemic crisis, counterparties will disappear and gross exposure will remain gross. Basically, in the case of Archegos, they got called on a margin call, they didn't have the cash, and guess who was left holding the bag? Well, none other than the bankster, hence why they were selling positions left and right, and all these corporations in huge chunks to boot. So all that netting doesn't stand up to real scrutiny, but it is typical for today's casino banking world when depositors, shareholders, and governments take all the downside risk and the management all the upside. So let's look at the global risk picture in the financial system. So the global time bomb here we got global debt and liabilities to the north of 2.3 quadrillion. Global debt about 300 trillion, derivatives is about 1,500 trillion, unfunded liabilities about 500 trillion, total debt and liabilities 2,300 trillion. Pretty soon it's starting to sound like funny money, like we're dealing in Monopoly here. You get the idea. The 2.3 quadrillion above is what the world is exposed to when this time bomb explodes. That is the total sum of global debt, derivatives, and unfunded liabilities. When all the dominoes start falling and no one can meet their obligations, this is what governments are left to finance. Yes, they will print this money and much more as deficits mount exponentially due to collapsing currencies. But the MMT, or the modern monetary theory clowns, will then find out that printed money rightfully has zero value. And it reminds me of the old quote that all fiat currencies return to their inherent value of zero. Absolutely true. And it's happened in history over and over and over again. Have we learned anything? Absolutely not. So as if these clowns studied history, they would learn that MMT has never worked. Just check the Roman Empire, 180 to 280 AD, France in the early 18th century, or the Weimar Republic, Zimbabwe, Argentina, and Venezuela in the 19th and 20th centuries. So, when fiat money dies, how much gold is required to repair the damage? Well, if we look at the cube below with all the gold ever produced in history, we see that it is 198,000 tons valued at 11 trillion. And here you can kind of see the depiction here. Below ground gold, about 54,000 tons. Private investment, 43,000. Jewelry, 93,000 tons. Central banks, 34,000. Other. You kind of get the idea. Bottom line, below the cube, the total central bank and investment gold is shown. This amounts to 77,000 tons, or 4.3 trillion. That sum represents 0.2% of the total debt and liabilities of 2.3 quadrillion, as shown in the time bomb. The 4.3 trillion gold value is at a gold price of $17.50 per ounce. This minuscule 0.2% of liabilities obviously is far too small to support global debt. A 20% gold backing of total liabilities would be a minimum. That would be 100x the current 0.2% or a gold price of $175,000. Now, I'm not forecasting this level or saying that it is likely to happen. All I am doing is looking at the total risk that the world is facing and relating it to the only money that will survive. Also, measuring the gold price in dollars serves no purpose because when and if this scenario happens, the dollar will be worthless, and the gold price measured in worthless dollars at infinity. So, and another thing I'll highlight here real quick, not to deviate too far, but the 1750, mind you, is a compromised price that we see spot gold and that's traded. We know that it's suppressed at best. Traders and that have been caught many a times over the years and basically gotten slaps on the wrist from the traders net who have speculated on gold and silver spot prices, keeping it depressed from where it realistically should be. And by the way, that also does not include the fact that here in these United States, our House of Representatives have abdicated their duty in coining money and determining the value thereof, and there's nothing that says that we cannot price gold at whatever we want, because at the end of the day, what is in Fort Knox or any of our reserves on house are still actually priced at back in the 70s level of about $40 an ounce. We could turn around and price that to $10,000 an ounce based on what our Constitution says, and our debt would be solved. What would that do for the rest of the world? Can't say, but nonetheless, you get the idea. It says focus on wealth preservation. Rather than focusing on a potential gold price measured in dollars, investors should worry about preserving their wealth in real assets held outside a bankrupt financial system. Regardless of what price gold and silver reach, history proves that it is the ultimate form of wealth preservation. It will not be different this time. Therefore, in the coming crisis, precious metals will be the best insurance to hold as protection against unprecedented global risk. Gold's rise since 2000 in no way reflects the massive money printing we have seen in this century. Still, as the graph below shows, gold is at the beginning of a very strong uptrend that has very far to go in both time and price. And here we just see a 20-year span. You can kind of see here depicted in the graph 2000 to 2012, 12 years uptrend, closing higher every year from $272 to $1,674, up 6x. 2013 to 2015, 3-year correction from $1,674 back down to $1,061. And this last 4-year stretch, or 5-year stretch, uptrend, closing higher every year from $1,061 to $1,898, up 80%. And if basically what they're saying in there, it's got legs to run with. Plenty of room to go yet. That being said, investors have the following choice. Either they follow the coming crash in bubble assets like stocks, property, and bonds all the way to the bottom, which is likely to be 75 to 95% lower in real terms, measured in gold. Obviously, we can't measure that in dollars because it's going to fail. Or they protect their wealth in physical precious metals stored outside a fractured financial system. As always, history gives the answer as to which path to take. So there you go. That's kind of the opening clause, if you will, for tonight. If you're not invested in gold or silver, have either like pre-1965 gold, if you can find it at a pawn shop or whatever. If nothing else, it's good to have a little bit of that, just because pre-1965 does still have some silver content in it, unlike today's coinage. Same is true if you try and go to any bullion places now, which you can find online, etc., etc. Try and get it now while it's quote-unquote, using air quotes behind the scenes here, cheap, in order to protect any wealth in that you may have left before the Fed breaks everything down. That being said, the ugly truth about printing press money. So M.N. Gordon had this the other day. Says, weeping and gnashing of teeth shall come. We don't know when exactly, but we do know a certain catastrophe is approaching. In fact, we can see it on the horizon. Does anyone in Washington give a rip the nation's beyond broke? Does anyone in Congress care that outright money printing is what financing their stimulus bills? Does House Financial Services Committee Chair Maxine Waters think it's all a real hoot? Surely, someone in the legislature is aghast at federal spending that's gone completely out of control. Are you aghast? We are. But there's nothing we can do to stop it. Nearly all remnants of fiscal conservatism have been quarantined from federal government. The majority of the electorate have voted for generous gifts from the public treasury. They want free education, free food, free phones, free transportation, and free drugs. They want debt forgiveness. Most of all, they want free money. Many representatives are pushing the president to give the voters what they want and what the politicians have promised, specifically more stimmy checks. According to MoneyWise, more than 75 members of Congress say that until the pandemic is over, there should be regular stimulus checks. President Joe Biden is being urged to wrap them into the $2.3 trillion infrastructure spending plan he's now promoting. Stimmy checks, as far as we can tell, have nothing to do with infrastructure. Yet, that's the beauty of perpetual stimmy checks in the interminable pandemic era. The legislature can wrap them into just about anything. All it takes is a simple stimmy check earmark. Hemorrhaging red ink. The longer personal livelihoods are... you know what? Whoops. My apologies. I just saw somebody's comment and saw that, and I said, whoops, that's no good. Let me quick back up here. That's a rookie mistake. Sorry about that, folks. Let me go back to the opening stanza here so you can actually see the article on that I just got done covering. Again, some of the highlights here, some of the graphics. There's the global time bomb in that I was describing. And, of course, here is the cube depicting the gold allocations, net who has what. And then, of course, this last chart here kind of depicting the upward trend of gold on the chart between 2000 and 2020. That being said, flashing over to the article now covering here. Let's see, yeah, pretty well caught up there. No graphics on this one. But nonetheless, the stimmy checks, as far as we can tell, have nothing to do with the infrastructure, as I stated. There we go. Hemorrhaging red ink. The longer personal livelihoods are funded by government giveaways, the more dependent people become. Those who were once self-supporting through their own work-derived income and now reliant on stimulus and generous unemployment checks. Why work when it's much more lucrative to loaf and invite your soul? Meanwhile, Washington's hemorrhaging red ink. This week, the U.S. Treasury Department released its monthly Treasury statement. It's unlikely Treasury Secretary Janet Yellen read it, but if she had, she would have discovered the federal government has already racked up a $1.7 trillion, T with a trillion, there you go, budget deficit in fiscal year 2021. Now, the fiscal year extends through the end of September. The running budget deficit reported this week was through March, the halfway point. At this rate, we're looking at $3.4 trillion deficit for the fiscal year 2021. This even tops the $3.1 trillion record deficit attained in fiscal year 2020. The federal government ran a budget deficit of nearly $660 billion in March alone. In 2017, just 4 years ago, the annual deficit was $666 billion. At this time, this was considered reckless and insane. Well, I don't know what the heck we call today then. It must be, I don't know. What's beyond insane? Stupid? I don't know. I'm at a loss. But now the federal government goes in the hole by $660 billion in 1 month, and no one bats an eye. What's more, Congress demands further spending. Bigger deficits, stimmy checks, earmarks, and uncompromising fiscal insanity. Where's the money coming from? One clue, folks. Print it out of the air. I mean, if the BIS can make it go away with a stroke of a pen, we can surely make it appear like a magic trick out of thin air, can't we? By now, anyone who's bothered to ask is clued into where the money comes from, and from where it comes is flagrant deception. The ugly truth about printing press money. The Federal Reserve adds a notation to its balance sheet, now over $7.7 trillion, and the credit magically appears from thin air. The Fed then loans the freshly minted credit to the Treasury through the purchase of Treasury notes. The Treasury then directs this printing press money into Washington's various spending programs. This inflation of the money supply is inflation in the truest sense, and it comes with destructive consequences. John Maynard Keynes, Fabian socialist and the godfather of modern-day economic planning, in his 1919 work, The Economic Consequences of the Peace, wrote, "By a continuing process of inflation, governments can confiscate secretly and unobserved an important part of the wealth of their citizens. By this method, they can not only confiscate, but they confiscate arbitrarily, and while the process impoverishes many, it actually enriches some. The sight of this arbitrary rearrangement of riches strikes not only at security, but also at confidence in the equity of the existing distribution of wealth. As the inflation proceeds and the real value of the currency fluctuates wildly from month to month, all permanent relations between debtors and creditors, which form the ultimate foundation of capitalism, become so utterly disordered as to be almost meaningless, and the process of wealth getting would explain the extreme divergence in net worth between the average congressional representative and the average plumber. What about the extreme divergence between house prices and incomes, or the extreme divergence between market capitalization and gross domestic product? The Dow Jones Industrial Average just eclipsed 34,000, and is this some kind of joke? After asset price inflation and wild gambling and speculation comes consumer price inflation, the real wealth destroyer. This is the ugly truth about printing press money. The ugly truth Fed Chair Powell and Treasury Secretary Yellen will never share as they champion the virtues of their policies of mass inflation. Weeping and gnashing of teeth shall come. And of course, if you were with me here earlier today when we were on the 5x5 channel with Homesteader and Drunk Pinata, we talked a little bit about that. And of course, if you're paying attention at all to wood prices, for example, lumber prices, lumber futures, anything of that likeness, commodity prices in general, steel, copper, you name it, the prices are going through the roof at the moment. Again, if you were to take a look at where you could get studs to build something, 8-foot 2x4 as an example, around these parts you could usually pick that up for about $2 a stud. Today we're looking at about $8. And of course in some other areas of the country I saw people floating through chat saying, hey, that's cheap, we're paying like $11 down here. So it's a major increase. And for what? For what? At the end of the day, it's because the Fed is inflating our dollars away. It's a hidden tax. And we're going to have to rectify that. The time to pay the piper is coming quickly. That being said, here's an interesting graphic via Visual Capitalist, a dollar's worth purchasing power of the US dollar. Obviously, many of you have probably seen similar graphics dating back to the early 1900s, where the Federal Reserve Act creates a central bank with the ability to manage the country's money supply. Obviously, that was back 1913, and this is on the far left here. Obviously, you can see what happened after the Great Depression in the 20s, what happened to our currency at that point, with a brief pickup with Roosevelt criminalizing the possession of gold. Turn in your gold, of course, that was 1933. And of course, the Bretton Woods Agreement establishes the gold standard in the US dollar as the world's reserve currency somewhere in the 1960s there. Flash forward into about 1971, the gold standard is abandoned, and currencies are no longer linked to gold, that under Nixon. Flash forward into about 2009, I suppose, when quantitative easing, QE1, begins in response to the financial crisis. That's after the 2008 crisis, where we had a little hiccup and basically credit drying up for the banks to use. And then, of course, into 2020, the U.S. money supply grew by $3.8 trillion in 2020, equal to 20% of all dollars ever created. Now think of that. All the dollars created from 1913 until 2020. How much that was. And now we've just increased the money supply by $3.8 trillion, which I think the run rate was, what was it, $160 billion since August 2019, somewhere in there, if I remember right. We can do the math, obviously, and kind of figure out the run rate. But that's why we're seeing the increases that we are. Our dollars are being inflated away. And of course, here you see what a dollar buys back in 1913. 30 Hershey's chocolate bars, $26.14. 10 rolls of toilet paper in 1929. 10 bottles of beer in 1933. Let's see, flash forward into 1944, you could get 20 bottles of Coca-Cola, which today I don't think anybody would pay anything to buy a Coke at this point. Keep that sucker on the shelf. In 1953, I guess, 10 bags of pretzels. One drive-in movie ticket in 1964, 17 oranges in 1971. Flash forward into 1987, you're talking about two boxes of crayons. Let's see, 1992, you could buy about 4 grapefruits. By the year 2000, you could get 2 lemons. And today, $1 is a McDonald's coffee. So there you can kind of see what the purchasing power of one single dollar did in that short amount of time, not even 100 years. That gives you a little bit of a perspective. All right, that being said, well, what about Bitcoin? Well, again, just talking about what I just covered there, what happened in 1933 when FDR banned gold. Could that potentially happen to Bitcoin? I mean, all one has to do is take a look at the headlines here today. You get people like Peter Thiel and various other outfits vilifying Bitcoin. And, of course, they'll try and castigate it and vilify it in every way, shape, and form. Why? Because they don't have control over it. At the end of the day, it's not a central bank sanctioned currency at this point. The central banks want to issue their own currencies and get everybody aboard because, just like I alluded to earlier today on the show, all you have to do is go back to the Rothschild quote, right? I care not what the laws are the country makes, so long as you give me control of the money supply, right? And that's exactly what they will try and do to keep the cartel rolling. The question is will we allow it? So out of the Mises Institute in the last beginning of the month, I suppose, 88 years ago, FDR banned gold. Will a Bitcoin ban be next? That is the question. It says today is the 88th anniversary of Executive Order 6102, signed by President Franklin Delano Roosevelt, forbidding the hoarding of gold coin, gold bullion, and gold certificates within the continental United States. The order was one of the several disastrous responses to the Great Depression that succeeded in escalating the financial crisis. Later in the year, the U.S. Congress would pass a resolution retroactively supporting the legislation. However, it was determined autocratic leadership of FDR that made way for these unprecedented measures. It would be a crime for Americans to hold gold for over 40 years, until President Gerald Ford reversed the order in 1974. This episode has several lessons for the current financial environment, particularly given the acceleration of tyranny by expert rule that has taken over much of the worst this past year. The underlying legislation that evoked by FDR's executive order was the Trading with the Enemy Act of 1917. Sound an awful lot like what we hear in today's rhetoric by those vilifying Bitcoin. A byproduct of World War I, despite the fact that the U.S. was in no way in a period of war in 1932. Similarly, we have seen war on terror, inspired financial legislation increasingly used against American citizens. For example, in the name of fighting terrorism, the U.S. Patriot Act significantly increased Know Your Customer laws, empowering federal regulators to use the traditional banking system to better track the economic behavior of American citizens. And of course, if anybody has ever tried to go withdraw $10,001 out of your account, guess what? It's a big red flag, and you just got put on a list. You withdraw anything under $10,000, chances are you're probably okay. Heck, they may have actually ratcheted it down by now, who knows. But at least that's what it was at the time. It says, in the eyes of the federal government, anti-terrorism legislation was quickly expanded to include additional missions, such as stopping money laundering and drug crimes. Increasingly, these boogeymen have been used by the policymakers around the world to erode financial privacy assets, such as cash and secret Swiss bank accounts. On the domestic side, we have increasingly seen U.S. corporate actors demonstrate their loyalty to the progressive political zeitgeist by proactively cracking down on various dissident political figures and conservative action groups. Bank of America, for example, has debanked various gun manufacturers and also turned over client data following the January 6th protests at the U.S. Capitol. These moves could prove useful if Bank of America needs another federal bailout from a Biden-Harris administration. but highlights the degree to which the modern financial system can be weaponized against a state's political enemies. And of course, a lot of that was brought about by none other than Eric Holder underneath 44 when they started using that little operation. The same playbook is being increasingly used to target Bitcoin and other cryptocurrencies that are beyond the reach of the state. Earlier this year, Treasury Secretary Janet Yellen indicated that cryptocurrencies are in her crosshairs, telling an industry roundtable that the misuse of cryptocurrencies and virtual assets is a growing problem. I see the promise of these new technologies, but I also see the reality. Cryptocurrencies have been used to launder the profits of online drug traffickers. They've been a tool to finance terrorism. Oh, I guess I'll pause there and state that perhaps they must have overlooked all of the criminal activity of the likes of the Credit Suisses, the Deutsche Banks, and the big bankstas in general. No money laundering goes on there whatsoever through those doors now, do they? Just overlook that. European Central Bank President Christine Lagarde has also called for global regulation of cryptos, responding to increased interest in these alternative assets. Of course, the increased interest in assets like Bitcoin is itself a direct response to the monetary policy of the Federal Reserve, ECB, and other global central banks responding to government-caused economic shutdowns in 2020. While central bankers often publicly dismiss the role of non-politicized assets like gold and Bitcoin in financial markets, in their own circles they understand the dangers that exist in allowing the public the option of opting out of their financial schemes. For example, at an annual Federal Reserve conference in 2016, the late Marvin Goodfriend noted the role that cash played in limiting what anti-saving policies a central bank could pursue. He advocated the abolishment of cash in return and drew comparisons to the elimination of the gold standard. In 2018, an IMF report warned that cryptos could reduce demand in fiat money and recommended rigorously applying measures to prevent money laundering and the financing of terrorism in an attempt to undermine this consumer behavior. Well, one slight problem with that is that Bitcoin in and of itself is indeed a fiat, so you're only replacing one fiat with another at the end of the day. But in addition, central banks have sought to compete with the convenience of digital currency by developing their own versions. China, whose central bank has been one of the most aggressive in credit expansion since 2008, has recently released a digital yuan, while the ECB is working on a digital euro. As I noted in 2017, this could set up a next-generation of global currency war between private crypto and state digital currency. Since it is the nature of a state to defend its power, we should expect to see regulators and central bankers around the world escalate regulatory and legal pressure against financial assets beyond their control. As FDR's gold crackdown showed, tyrants know the importance of controlling money in a time of crisis. Thankfully, so far Bitcoin has demonstrated resilience against the most forceful of state actions. For example, in countries like Morocco, which has banned Bitcoin entirely, peer-to-peer trading of Bitcoin has skyrocketed. What will be interesting to see is whether countries that are suspicious of international governing organizations, such as the IMF, EU, and UN, recognize the political value of private money as a check against globalist political hegemony. How we've seen Russia recognize the value of gold as a check against the weaponization of the dollar. Could Bitcoin be next? So there you have it. Could Bitcoin be next? Again, mark my words, they will continue to try and vilify it. The question is will we allow it? And just as I showed at the very beginning here, the woke corporations, they're doing the bidding of the government at this point. The government may refuse to put anything on law or have legislation passed, I should say, or even by executive decree by El Presidente. So, what the government can't do And because they're now fascist in nature, the line is blurred between corporations and the state. Now they'll just get the corporations to do the bidding for them. And because they have been interwoven into society, they think they have the authority to rule over us and tell us what we should or should not do. And just like I said with the Georgia integrity law, they want to institutionalize the fraud, right? And the question is, can we withstand that? Well, what happens if those corporations side with the state and their central bank money, but we, on the other hand, say, nah, I don't think so. We're going to support the mom and pop shops, and guess what? We're not going to buy anything of yours, and we're going to support a currency like Bitcoin, if it indeed becomes in a position where we can actually use it as a currency instead of it just being a holding asset. Now they've got a problem. We don't buy their crap, we don't use their money, but in the meantime, we support ourselves, our local businesses, with an independent coin and currency. Could happen. Stay tuned. That being said, let's close things out with this guy. This is a little bit of a longer read. Why the future money is gold and silver. And of course, I'm a big advocate of what has traditionally been seen as money and withstood the value of time. It's never changed. It's always been an asset that's been around. You get people like Greenspan, former Fed head from back in the day, who used to basically say it's not worth anything, it's just a lump sitting there, it doesn't do anything for you. But in times like these, when you've got the money printers fired up at the Federal Reserve, it's going to withstand the test of time. It'll still be there, same as it was yesterday, today, tomorrow, while the dollar gets inflated away. So that being said, a reminder of why they always will be sound money and why Bitcoin cannot fill that role. So with Bitcoin's price still rising and expected to rise even more, there has been a growing belief in cryptocurrency circles that it will replace unbacked government currencies when they eventually fail. The assumptions behind this conclusion are naive, exposing hardly any knowledge in what quantities are needed for sound money. This article agrees that current events are accelerating the path toward fiat destruction, and that historical precedents point to their eventual replacement with a sounder form of money. But what that money will be is decided when governments lose control over their fiat, and the public, its users, through free markets, will set the monetary agenda. Only then will the general public determine the qualities required, and in the past, it has always opted for metallic money. And because government treasury departments and their central banks coincidentally possess only gold in their non-fiat reserves, its monetization is the only option for governments to survive the collapse of their fiat currencies. That is what will eventually happen, with silver perhaps fulfilling a subsidiary monetary role to gold. So in an introduction here, it says, while increasing numbers of the fiat investment community understand that the quantities of government money are being expanded without any sign of limitation, they have also concluded that Bitcoin, not gold, is a pure investment play, because over the next few years Bitcoin will approach its final quantity. It is almost certain that, like the majority of gold and silver bulls, hodlers expect to sell Bitcoin for profit measured in their government's currencies, creating for themselves relative wealth in dollars, euros, yen, whatever their government imposes on their citizens as money. But it is an investor's or speculator's approach, which is accompanied by feverish examination of charts, confirmation bias from experts, and only a half-understood concept of what is driving the price. So sudden and wonderful has been the unbanked wealth creation in leading cryptocurrencies that investors commonly proclaim that gold and silver are yesterday's story, and that we oldies should move with the times. These investors claim that 5,000 years of empirical evidence is about to be overturned, but they are investors, all bulls and no bears. Other than banking fabulous profits in fiat at a future date, this has nothing to do with money per se. The point about sound money is you acquire it by spending fiat, so that when fiat goes, you will have it to spend. It is not an investment decision, but more like an insurance policy taken out for which a risk assessment has to be made. If it is decided that the risk is that fiat currencies will not fail in one's lifetime, then the insurance premium, which is an individual's decision, need only be small, or not even taken out. But if it is decided that the risk is there and growing, then the allocation into physical sound money should be increased accordingly. Lack of physical ownership, be it Bitcoin, gold, or silver, is not an option. There is no doubt that economic and monetary instability are increasing. After all, this is fueling the investment rationale for Bitcoin, understood by those whose reasons for buying it are to benefit from its slow rate of quantity expansion compared with that of fiat. But the investment rationale is that all the subjective price performance is in Bitcoin, and the national currency is the unchanging objective value. Otherwise, why value Bitcoin in your fiat currency, and why would you ever sell it? And do you ever adjust your other investment returns for the debasement of the currency? No one does this. The objective view of currency is so powerful that very few people can get away from it. But the decision to insure against the death of fiat currencies is about advance possession of their likely successor, not measuring gains. It requires an understanding of what money represents, its function, and the what and the why that is happening to fiat currencies. It involves an understanding that fiat money is being debased, and what that really means for the sound money of tomorrow. And it requires individuals to comprehend what is happening to fiat money's objective value, evidenced by rising commodity prices, stock markets, house prices, Bitcoin as well as gold and silver, all measured in fiat. Today, very few owners of precious metals or of Bitcoin understand that investment is fine and dandy, but the ultimate reason for possessing them is against the possibility that fiat money will fail. They are not yet to make an informed choice about what that replacement will be, and talk of Bitcoin going to $1 million or gold going to 5,000 misses the point entirely. And I guess I'll pause there real quick to state that I don't know that we know what comes behind the Federal Reserve debt note. There's been a lot of talk that we may see treasury notes that could indeed be backed by gold and or silver. We don't know what the ratio between gold to said treasury note may be. Then, of course, if you want to go down this path, you got the NESARA GESARA folks who think that, all this stuff is just around the corner as it has been for 20 plus years, still waiting. I'm not going to beat on that too much here, but you get the idea. Something is probably in the works. We just aren't privy enough to see what exactly that is. So, characteristics of sound money. So, in terms of fiat replacement, Bitcoin, gold, and silver, how they stack up. Public acceptability, Bitcoin is strictly limited. Gold and silver, both global. Officially sanctioned, Bitcoin, no. Obviously, gold is, yes, and silver, unlikely. Track record, no track record for Bitcoin, but extensive for both gold and silver. Monetary flexibility, none for Bitcoin, yes and yes for both gold and silver. Financial flexibility, no for Bitcoin, yes for gold, and partial for silver. Now again, I guess maybe one thing I might highlight here real quick is that they're comparing this solely on Bitcoin. That's not to say that, Ethereum or Dogecoin or any number of these other cryptos net out there couldn't potentially be used. Obviously, for the sake of argument here, they're just, in my opinion, they're using Bitcoin as the de facto cryptocurrency, probably the one that most everybody's heard of. Figure 1 gives us a basis for assessing the credentials of the principal contenders to replace fiat money when it dies. It should be noted that throughout the history of money mandated by governments with nothing to back it other than its legal status, has always failed and been replaced with money which is essentially chosen by individuals through their personal exchanges with each other. With the invention of cryptocurrencies, there is offered a new technological form of money which claims to be sound, competing with the established metallic monies of the past for attention. We can ignore centralized central bank cryptocurrencies on the basis that is just rearranging the deck chairs on the fiat Titanic. In estimating the suitability of each form of money, they have to survive the tests and figured one. Clearly, gold satisfies all categories, but some explanation is needed why this is so, and why Bitcoin and silver do not. So, public acceptability. Both gold and silver have acted as money for millennia and are widely distributed. They are generally associated with a monetary value, that is to say, any suitable to be a medium of exchange. Indeed, silver was the basis of the pound sterling from as early as 775 AD and was the monetary standard until the adoption of the gold standard in 1816 through Sir Isaac Newton. Though Sir Isaac Newton introduced a secondary standard for gold in 1717. That's over 1,000 years of monetary silver. Silver was still the currency standard in many jurisdictions on the European continent until the Franco-Prussian War, when Germany exacted tribute from France in gold, allowing it to exchange its monetary standard from silver to gold. Both metals have a long history of being used as money throughout Europe and Asia. And when Columbus discovered the Americas, it was found that these metals were also valued by their civilizations, principally the Aztecs and Incas, which had no prior trading connection with Europeans and Asians. Deep in the human psyche, there has always been an appreciation of their constancy and their suitability as mediums of exchange. The same cannot be said of Bitcoin, which is held out as the leading and most sound cryptocurrency. But its distributed ledger cannot be corrupted by anyone, including governments. So long as electricity flows through our economic veins and our computers and mobile phones remain interconnected, there will be Bitcoin and its blockchain. Yeah, wonder how well that would have worked down in Texas, let's say, when they were without power. Oh, you don't have any money? Oh, no electricity? Well, I guess you're kind of screwed on buying or selling, aren't you? I guess take your hard drive down and say, hey, I got stuff cold stored in here. Okay, prove it. But as a replacement for fiat, it suffers many disadvantages, some of which will doubtless be overcome. But the one thing it cannot do is act as a medium of exchange for those unwilling or unable to use it. The hodler's enthusiasm for Bitcoin as money does not stretch much beyond educated millennials, less than 100 million, perhaps, out of a transacting population of 7 billion. It falls at this fence because it is not hodlers who ultimately decide what to use as money, but the wider public. But Bitcoins are already accepted in some outlets, and even Elon Musk is said to accept them in exchange for his Teslas. Maybe, but if someone thinks Bitcoin is going to rise in price, then they would likely accept it as payment. It would be a way of acquiring Bitcoin so that they can be sold for a greater profit at a later date. This is not Bitcoin being used as money. And real quick, obviously talking about Mr. Tesla himself, Elon Musk, he's talking about this latest goofy cryptocurrency that came about on a whim, Dogecoin. And what's interesting about that is that all it took was him tweeting about it, and mysteriously everybody piles in, and all of a sudden the thing takes off. So could you imagine if people did that with a dollar today? How stable would a dollar be in terms of products and services that we buy if all it took was somebody just saying, hey, blah, 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 and all of a sudden the dollar rises 400% in 2 days? That's exactly what happened with Dogecoin, and it's taken off. Public acceptability. For a medium of exchange to be effective, it must be accepted by everyone in a community of people who divide their labor, and if one community is to benefit from trading with other communities, it must be accepted more widely for the exchange of goods. but we know that confining transactions to coins or metallic money by weight is an inefficient form of money. This is why fiat currencies started out as gold or silver substitutes in the forms of both cash and bank deposits, exchangeable into physical metal on demand at a fixed rate. The convenience of being able to pay in sound money substitutes cannot be underestimated. A national currency fully fungible with gold or silver was central to the economics of the Industrial Revolution and is the basis of the currencies of the great nations of today. Markets in them developed, such as discounted bills, loans, bonds, stocks, and trade finance. Gold and silver substitutes were trusted. Businesses developed internationally, exchanging their money substitutes for commodities, importation of consumer goods, and goods of a higher order. While country A's money did not circulate in country B, it was accepted and could be redeemed for its money at a cross rate fixed by their gold standards, or, alternatively, exchanged for physical gold. This was the basis of global trade before the First World War. The monetary system, based on the free exchange of gold and silver substitutes, was so successful that it brought the nations that benefited from the arrangement out of feudal subsistence, living into the greatest economic advancement for mankind since the ending of barter. It set the basis for modern economies and their technological advancement. Money could be trusted. You could save it, making it accessible for entrepreneurs to finance their production, knowing that gold or silver-backed money would retain their purchasing power over time. It was fundamental to the evolution from medieval societies into free markets. Through their money substitutes, it was governments and their central banks which cheated on metallic money, starting with the suspension of gold standards to finance the First World War. European nations failed to return to them, and some currencies collapsed. Britain eventually introduced a gold bullion standard in 1925, replacing its gold specie standard at the pre-war rate. By only permitting the exchange of pounds for 400-ounce bars and removing the pre-war commitment to swap paper pounds for sovereigns, the general public effectively lost the gold and substitute facility. The UK's bullion standard only lasted until September 1931, when it was temporarily, quote-unquote, abandoned, never to be reintroduced. Isn't that interesting? Only 2 years before we saw these United States go off the gold standard. Almost as if that was planned, huh? The flaw in the system was not the fault of gold, or, in earlier times, silver. The fundamental problem was that banks were free to expand the quantity of money in the form of credit, which, when drawn down and spent, was indistinguishable from gold substitutes. Following the Bank Charter Act of 1844, which permitted the existence of unbacked bank credit, the cycle of bank credit expansion was broadly self-liquidating through periodic bank crises. That changed when the Bank of England adopted the role of lender of last resort, subsequently copied by the Fed. The credit tail had begun to wag the monetary dog, and led to the situation today, where money originating from bank credit makes up the bulk of money in circulation. Without a reform of the banking system to restrict the role of bank credit, the reintroduction of gold and silver substitutes is corrupted and cannot work for long. This must be addressed when fiat dies. Otherwise, the cycle of bank credit will destabilize the new monetary system. So if Bitcoin is to be the money of the future, it will need enormous degrees of persuasion for the public to accept it as sound money compared with gold or silver. That persuasion is unlikely to come from markets, which are the sum total of people's transactions, so it can only come from the state. An establishment agency of some kind, a revolutionary government in agreement with other revolutionary governments, would have to successfully impose a cryptocurrency over which no state has distributive control on the general public, whose traditional concept of money is very different. Not only is this proposition illogical, but it is logically the consequence of assuming the state decides what is money and not the people. Official sanction of the new money. The last thing any government or central bank would wish is to lose control over money. These agencies will continue with fiat until the last possible moment and will then want to determine its replacement. Intellectually, they are not suited to the task, believing that the state must retain control of its national money at all times in order to manage economic outcomes. It sees free markets as the enemy of state-imposed order. The collapse of fiat currencies will demolish the state theory of money, and not for the first time. Irrespective of how long it takes, the rapid loss of fiat currency's purchasing power means that governments will no longer be able to finance their obligations. There will, therefore, come a point when fiat money must be abandoned in the search for monetary stability. The demise of fiat is the demise of state money, and the function of its replacement will be to restore public trust. It is theoretically possible for trust to be restored without abandoning fiat, but that would be to act in anticipation of a monetary crisis. Cutting government spending to an economically sustainable level, balancing budgets, reforming the banking system, and abandoning regulatory and other interventions in favor of free markets would have to be a deliberate policy. But it is unlikely that the necessary reforms would be possible politically ahead of a major economic and monetary crisis. Therefore, the crisis comes first, and then the state responds with an electorate fully aware of the consequences of failure. I might disagree slightly with that because, as we well know, the Hegelian dialectic should apply here. Obviously, problem, reaction, solution. They already have the solution in mind, make no mistake. Hopefully this article may cover that. We'll see. It says at some stage in the collapse of a fiat money's purchasing power, it will have to be halted. In November 1923, Germany's paper mark was finally exchanged for a new mark, notionally tied to the gold mark at the rate of 1 trillion to 1. The reasoning behind the conversion rate was it enabled the Reichsmark to enter circulation. Today, the replacement of fiat currencies with new money will almost certainly follow a similar procedure. The replacement money can only be based on something in government's possession, and either in their treasury departments or central banks, other than each other's fiat, that they only possess gold in their monetary reserves. It may take a few debilitating attempts by states to avoid it, but we can be certain that the only replacement for fiat money will be to back them with gold. It is necessary to establish everyone's money. The other actions, reducing the scope of government and freeing markets from intervention, will also have to be addressed. But following the increasingly obvious prospect of a total monetary collapse, stabilizing the currency by turning it into gold substitutes exchangeable for gold coin should then become a politically viable solution. It is not the intention to make light of the difficulties involved, nor to dismiss the political consequences. Based on the German experience following the collapse of its paper mark, Hayek's The Road to Serfdom is instructive reading. The demise of the dollar raises geopolitical questions, because China has effectively cornered physical gold markets, and there is evidence that she has accumulated very large quantities of non-monetary gold. Gold as circulating money would enhance her power relative to that of the United States. Russia's central bank has also built her gold reserves at the expense of the dollar, and can be assumed to have accumulated significant amounts of physical gold not otherwise declared. The time taken for a fiat monetary collapse is another important factor not addressed in this article, but will have significant consequences. If it is as much as a year from now, governments might introduce price controls and attempt to confiscate gold. These are traditionally resorted to in the past, going back as far as Roman times. The introduction of central bank digital currencies might just be advanced, hurried along by falling purchasing power for traditional fiat, and the impoverishment of the middle class through monetary inflation must not be ignored. But eventually, a movement towards gold substitutes is bound to occur, and silver can then become supporting coinage. But one thing is clear, and that is a publicly distributed ledger cryptocurrency not in possession of the state cannot be adopted as a substitute for its fiat currency, because states do not have the means to introduce it. Interesting. In terms of monetary flexibility, it is a mistake to think that a sound money is one that doesn't vary in its quantity. The point behind sound money is that it is the users, the general public, and businesses who decide the quantity required, and not the state. It was George Knapp's State Theory of Money, published in 1905, that led to Germany's inflationary financing that ended with the paper mark collapsing in 1923. It was Knapp's theory and his Chartist fellow travelers that permitted Germany to arm itself ahead of the First World War, and then to prosecute it at no visible cost to the taxpayer. It is not a strict limitation on the quantity of money that is the problem. It is who determines the quantity. We are told that above-ground stocks of gold total some 200,000 tons, and that its extra supply is about 3,300 tons of annual extraction, growing at about 1.5% annually. That is wrongly taken to be gold's money supply. Monetary gold is just one function of the metal, and only 35,220 tons are officially monetary gold. In addition to official holdings, there are vaulted bars on behalf of governments and their agencies not officially designated as money, as well as hoarded bars owned by the general public. And with an estimated 60% in the form of jewelry and other uses, that leaves a global gold money supply of about 80,000 tons. This gives gold enormous scope for increasing its monetary use. If gold is used as backing to turn fiat currencies into credible gold substitutes, its purchasing power becomes the determinant of the quantities of scrap, acting as an arbitrage between uses. Free markets will decide how much gold is needed, and the supply is available if required. With its predominantly industrial uses, silver acting as money is a more complex issue. Increasing values relative to gold will diminish industrial demand until the time monetary stability eventually returns, leaving the majority of an estimated 840 million ounces annual mine supply then feeding into the quantity of monetary silver. But unlike gold, above-ground silver stocks are minimal, and furthermore, ownership of monetary silver by government agencies is virtually non-existent. And having been generally abandoned as monetary backing for notes issued in European states as long ago as the early 1870s, silver is likely to have a future monetary role only secondary to gold. But its reintroduction as coinage would serve as a public affirmation, along with higher value gold coins, that currency reform is soundly based. Unlike metallic-backed money, for its hodlers, the virtue of Bitcoin is the strict limit on its quantity, meaning that so long as governments expand their fiat money quantity, its price is bound to rise. But if the general public has determined the future of money through free markets, there will need a form of money whose quantity is not dictated by government and the banks. Under a Bitcoin standard, one country can only expand the quantity of its Bitcoin in circulation by obtaining them from another country. The economic mechanism is for the country to have lower prices of goods and services than the others, so that it obtains Bitcoin in payment for net exports. Assuming no change in the proportion of savings relative to immediate consumption, this would require the government to increase its surplus of revenues relative to spending in an attempt to suppress demand in its own economy and thereby lower prices. Consequently, a Bitcoin standard requires government intervention to operate, with government setting marginal demand, but they cannot act in concert. And if one country contrives to increase its quantity of circulating Bitcoin, it causes more accurate deflation in the others. The lack of any monetary flexibility is Bitcoin's Achilles heel. So in terms of financial flexibility, following the ending of the post-war Bretton Woods Agreement, over the past 50 years, financial markets have developed on the back of an unprecedented expansion of the quantity of money. In the U.S. alone, since August 1971, broad M3 money supply has increased from $685 billion to $19.4 trillion, a multiple of 28 times. And the major U.S. banks have increasingly diverted credit expansion from financing production to financial activities. These include purchases of government and other debt, rising from $160 billion to $4.92 trillion over the same timescale. The expansion of regulated futures markets and the far larger over-the-counter markets have been explosive, with the Bank for International Settlements estimating the notional amounts outstanding of OTC contracts at $609 trillion in June 2020. While much of these increases are the consequences of monetary inflation, there can be little doubt that having the ability to hedge risk, which is what derivatives are all about, is demanded by economic actors in any monetary system. In fact, futures, forwards, and options existed long before the current fiat regime. We must therefore assume that financial markets will continue to find these services demanded, but perhaps in lower quantities. A replacement monetary regime must therefore allow for derivatives and other financial activities, such as trade finance, and the provision of credit to the non-financial sector to continue. The fact that derivatives have a longer history than fiat money is proof that metallic monies are no obstacle to them. Similarly, bond markets existed alongside bank credit, which are necessary to facilitate production and therefore consumption. With prices generally stable, the purchasing power of metallic money increases over time as a result of competition driving manufacturing innovation, along with the development and application of new technologies. Consumers can save in the knowledge that they are safeguarded from monetary debasement by the state, and that their standards of living will improve over time, along with the purchasing power of their savings. And of course, if you look at the way things are playing out today, it's going the opposite direction, isn't it? None of this would be possible with a form of inflexible money, strictly limited in its quantity. Instead of the current situation of wealth being transferred from depositors to borrowers through currency debasement, wealth would tend to flow strongly the other way, only offset by contracting economic activity to act as a counter-pressure on a tendency for a rise in the purchasing power of a fixed quantity form of money. The world as a whole would find itself in a permanent depression led by a decline in production. Banks would be unable to fund themselves beyond sight deposits, with negative interest rates likely to be offset the fixed money supply leading to its increasing purchasing power. Bond markets would be driven by negative yields increasing along the yield curve. In this upside-down world, no entrepreneur would consider financing production from initial investment to final product sales, because prices for final products in that fixed currency would almost certainly fall substantially over time, and the wisest choice a consumer might make would be to spend nothing except on the barest essentials in order to hoard as much of this fixed quantity money as possible. These would be the basic conditions under a Bitcoin currency regime. No more luxury goods, I suppose, if everybody is just hoarding coinage and necessities only. So the conclusion, to wrap this thing up, says this article has made the simplest assumption that the demise of fiat currencies will be succeeded by sound money. It has glossed over the likely political and economic turbulence with such a change could cause, which is assumed herein to be a temporary phase. Nonetheless, there are other institutional changes that need to be made for the introduction of a sound money regime to stick. These include governments reducing both their financial commitments and economic involvement to a bare minimum, maintaining balanced budgets, not discouraging savings by taxing them and ensuring they never take actions which discourage free markets. It must be admitted that the prospect of a smooth transition to sound money is close to zero, but transition there will eventually be. This article has also played down the role of banks, whose credit creation is by far the greatest factor in the expansion of money. The misunderstanding of the importance of the factors behind the cycle of bank credit expansion and its sudden episodes of contraction led to interventionist policies with fatal long-run consequences. It is not generally understood that banks create money, with the financial establishment believing they simply have an intermediary role. It is not for the first time we see the high priests of central banking being utterly deluded about the business of commercial banking. In a monetary revolution, there can be no place for this type of loose thinking. So with it will have to be a process of rapid re-education for politicians and planners alike, probably in the real world of experience. Bank reform will have to be aimed at dampening the bank credit cycle. Purists of the Austrian school have suggested that banking must be realigned into deposit takers, who operate as off-balance sheet custodians and financial arrangers for savers investing in productive enterprises. Then there should be no doubt in anyone's mind about the status of their money, and unbacked bank credit would be eliminated. While this approach isn't ideal, it might be more practical to simply remove limited liability from banks. This would allow them to continue with existing banking practices and accounting, but the risks arising from balance sheet leverage would be significantly reduced because the homes and other assets of shareholders and directors would be on the line. This simple measure would likely be enough to drive banks toward the Austrian solution. Aside from the institutional changes, the eventual replacements for fiat currencies that will eventually be required will be driven by the establishment attempting to save itself from only having a worthless currency as its means of finance. Inevitably, it will require governments to use the only means at their disposal, and that is to monetize gold reserves because they are the only money they possess in non-fiat form. On this basis alone, cryptocurrencies, including planned central bank cryptocurrencies, which are merely another unchecked form of fiat, don't even get to the starting gate. And if that were not enough, we have established that a future sound money must be flexible enough to not only finance production, but to act as the mainspring for markets. Bitcoin enthusiasts have failed to grasp the importance of a degree of flexibility in the quantity of money, driven by free markets and not imposed by the state, for it to act as a medium of exchange. For now, Bitcoin as money is merely poorly informed speculation, and when the world has returned to metallic money for all the reasons outlined in this article, Bitcoin's legacy will be the invention of a blockchain and all that follows it, and not its price in fiat currencies, which will be of no consequence. So there you have it. Bit of a long read, as I stated, but a worthy read nonetheless. Helps you understand money creation by the central banks, how that works, why at least this particular author feels that cryptocurrencies don't meet the mark. Part of it being, obviously, there's no history, really. It doesn't have 5,000 years of backing like gold or silver do. And there's advantages to both. I think one of the advantages I see, at least on the cryptocurrency side, is the blockchain technology, the ledger-based system, which is pretty rock solid, I would say, in terms of not being able to be hacked. Obviously, it's 256-bit encryption, all that good stuff behind it. But at the same time, again, who is going to accept a Bitcoin? And just as the latter part of this article states, if you don't have the ability to fund production and thus consumption, what are we really left with? How does that monetary system as Bitcoin expand and contract as needed? Can it? Will it? Will they change the rules for it? I don't know. But I will say the other thing is this, is that the central banks are going to be no better. Even if the Federal Reserve introduces a CBDC, central bank digital currency, are they going to adopt a similar policy to what the PBOC just kicked out, the People's Bank of China? Because if you've been paying attention, China is of the opinion that their cryptos net are going to have an expiration date on them. And so, in order to foster the god of consumerism, thou shalt continually buy, if you do not use your currency in an allotted time, guess what? That currency disappears, and you're left with nothing. So there is no more saving for a rainy day, for anything. You get it, you spend it. You get it, you spend it. That's it. No more savings. So that's where things are headed at the moment. It's going to be interesting to see how this plays out, and I'm very keen to see what is going to happen here by month's end, because many of you, if you remember right, as I talked about this here maybe a couple episodes ago on some financials, there's an interesting bit of prophecy in that coming up toward the end of the month, that there's going to be a major shakeup end of this month. And so we're not too terribly far away from the end of April here. You can kind of see a little bit of things shaping up here. Like I said, with the Archegos, the Greensill stuff playing out, how potentially things could start to unwind, the derivatives market, things of that nature. So it's going to be interesting to see how this ultimately shakes out, and if that prophecy does indeed come to pass. So stay tuned in that regard. I'll certainly have more as I see various articles come through. All right, well, that being said, apologize for the little bit of a hiccup in that on the front end here, and not having my stuff together apparently, and getting everything sorted out. But nonetheless, interesting times in which we live, obviously, and where things may head in terms of our monetary systems. And of course, like I said, don't believe the garbage you get off the Mockingbird media about no inflation and it's really small. We're only seeing 1.2% a month, whatever. But again, if you look at that in a 12-month sense, 1.2 times 12, then you obviously can see how quickly that is adding up on an annual basis, not a monthly basis. Look at things on a year-over-year basis. What did you pay for something last year versus what are you paying for it now? If you look at it in the sense that they try to explain it, you're not going to notice a difference what you paid for it last month versus this month, unless we get to a situation where we're like the Weimar Republic and we start physically having to carry wheelbarrows full of dollars around to buy a loaf of bread. Let's hope we don't ever get to that point. All right, like I said, that's going to do it for this episode tonight. Appreciate you guys tuning in for the late edition here. We'll probably have more here in the coming days, and if nothing else, we'll see you back here real soon. Take care. God bless everybody. We'll see you next time.